Hey, good morning, everybody, and welcome to this episode of Trading Places Live. It is Tuesday, May 13th, 2025. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with all of you this morning. A couple things in the news before we get started. First, we had the April CPI come out this morning. And once again, we've got a Fed that's been fearing inflation, and the numbers came in below expectations. No shocker to me. But for those that just keep hoping or dreaming about surging inflation, it's just not happening. We got the core CPI for April out, and it came in at 0.2%, which was 1/10 below the expected 0.3%. And quite honestly, is kind of on par with the Fed's target 2% threshold for the year. The headline number, of course, CPI also came in 1/10 of percent below expectation. So really, no signs of any kind of significant impact as a result of the tariffs. And of course, over the past few days, we've gotten some pretty good news on the tariffs themselves in terms of pauses and deals, frameworks, and so forth set up. So, we saw yesterday the volatility index drop below 20 for the first time since all this panic and fear began. And so, we're just slowly going right back to where we were. The S&P 500, not too far from its all-time high, believe it or not. After losing 1,300 points, we climbed back within about 300 points of an all-time high. So we've gained over 1,000 points back on the S&P 500. Really encouraging rally that we've seen. Also clearing on the S&P 500 a key price resistance level yesterday at 57.82. That particular, the last time we went up, tried to get through that 57.82 level. Remember, we had an intraday high of 57.86, and then we failed to close above that 57.82 level. Well, we actually had that low yesterday after we gapped up through resistance. The low came down to 57.86 before it turned back around and moved back to the upside. Anyhow, so inflation, at least for today, not a problem. And for me anyway, the consumer side of inflation is the side that I'm really most interested in. The producer price index, which will be out on Thursday, is more of a look at the manufacturing side or the producer side of the equation, which sometimes you can see movements up or down there, and it doesn't get passed through to the consumer. So it's more important, in my opinion, what is happening at the consumer level. And once again, we had another relatively benign inflation report. So again, I'm going to ask the question to the Fed, what inflation are we talking about? Because just not seeing it. Everyone was looking for it with the tariffs, still not seeing it. I'll just rest my case there. And that's why we're seeing the market move back to the upside, because the stock market has not been acting like there's an inflation problem. We've got the 10-year Treasury yield still down in the 4.3% range. I didn't see exactly where we closed yesterday, but we'll look at that in just a bit. But 4.3%, that's, if you're buying a 10-year Treasury yield and it's yielding 4.3%, you certainly don't have a whole lot of inflation expectations built into that. So anyhow, I thought that was a really big report. Futures did move up. They started coming back down. I'll give you those numbers here in just a minute. One other piece of news that I did want to mention this morning, though, United Health Group, which has had an awful 2025, took another big hit this morning. Their CEO has stepped down. They have gotten rid of all their guidance for 2025. They said their medical costs are way above expectations, and the stock was taking about another big 10% haircut this morning. It's been a pretty significant drop on UNH over the course of the past several months, and we'll try to take a look at that chart in a little bit as well. But let me give you some of these numbers on futures this morning. Bear with me. I'll just pull them up in my other computer here. All right, so we've got the diamonds, which of course track the Dow Jones, currently down 0.4%. So maybe, we are up against a pretty key level on the small caps, which I'll talk about in a little bit. But anyway, Dow Jones down about 0.4%. Spider, which tracks the S&P 500, is relatively flat, just up a little bit. So when you get good news like you get this morning with the CPI and futures start to move up and then come back down. Actually, let me get you off of that screen because we're not going to go. That's for later in the show. But we'll take a look at the action here in just a second. But let me pull up the QQQ, which tracks the NASDAQ 100. That's up about 0.25%. So it is still up, even though it is down from where it was earlier this morning. And then the IWM up about 0.6%. So the IWM actually doing very well. 208.86, I believe, is the number to watch on the IWM. And with 25 minutes to go to the opening bell, we're trading right now at 209.09. So we're up about 23 cents above a key resistance level that I'll show you in just a little bit on the IWM chart. But before we get into all of that, I do want to go over what happened yesterday. Let's do a quick recap. So you can see the Dow Jones Industrial Average up 2.8% on Monday. Nice start to the week, gaining over 1,100 points back to 42.4. Of course, the big number we're watching is up closer to 45,000. That's where we need to get back to that all-time high. S&P 500, there it is, 58.44. Remember, we hit a low of 48.35 on April 7th. That was 5 weeks ago. We're up over 1,000 points on the S&P 500. Now, 1,000 points on the Dow doesn't seem like as much. I mean, we did that in one day. That's only a couple percent on the Dow. But on the S&P 500 with the index prior sitting at 5,600 and change, having a big move like yesterday, 3.25% on top of everything we've seen since April 7th, to move back up over 1,000 points in a little over a month. I mean, we're talking about a 20% move off that 4,800 low, 48.35. 20% move to the upside. Guess what that's called? A bull market. So, this is how quickly things have turned. And the reason why, when we were down 20%, I kept saying the risk is being in cash or shorting the market after we had already dropped 20%. When you get a cyclical bear market within a secular bull market, you have to understand the risks have changed. It's not whether or not the stock market's going to shoot right back up or whether it's going to keep going down to the downside. You just have to recognize that the risks of being short or the risks of being out of the market are increasing. You want to be back in. Hold your nose if you have to. Hold your nose and jump in. But I just believe, and I've said this all along, we are in a secular bull market. Get a lot of opposition to that. I've gotten a lot of opposition to that over the past several years. I stick with it. I'm telling you, we're in a secular bull market, and it isn't ending anytime soon. We've got probably another 6 to 8 years of this, in my opinion, to the upside, with periodic scares to the downside. That's what I believe is going to happen throughout the balance of this decade and into the next decade. At some point, probably in that 6 to 8 year range, we're going to be getting closer and closer and closer. If I'm right about this secular bull market and we keep going higher, we're going to get closer and closer to a long-term point on the chart, which tells us we're going to have significant risks ahead. But we're still quite a ways away from that. The NASDAQ yesterday jumping more than 4%, 4.3% back to 18,700. That was 780 points yesterday. Huge day. S&P 400 mid cap gained 3.5%, and the 600 small cap gained 3 2/3%. So it was a big day across the board, no matter what you looked at. Transports in particular had a phenomenal day, and we'll look at that in just a little bit as well. But here's another key thing to pay attention to. The volatility index was down 16% yesterday. Remember when it was at 55 5 weeks ago? Well, it's 18 now. Market makers are pricing options much, much cheaper. Why? Because they're not looking for the kind of volatility going forward that they looked for a month ago. We saw what the volatility was a month ago. Now that the volatility expectations are coming down, we should expect more and more bull market type action, in my opinion, which means we're trending higher. Watch rising moving averages like the 20-day moving average to the downside. That's your support. I know a lot of folks have been kind of paying attention, looking at the 200-day moving average. You don't even see that on my charts. I'm not a fan of the 200-day moving average. I think by the time you're hitting the 200-day moving average, it's too late. I mean, you should have already made some move. If you're waiting to go below the 200-day moving average, many times a cyclical bear market, as soon as you go below the 200-day, you reach a bottom and you turn around, you come right back up. I mean, if you go back and look at the history of cyclical bear markets. So that's the reason why I don't have it on my chart. If I haven't figured out that the market's going lower by the time we get to the 200-day moving average, there's something wrong with my method, quite honestly. And I'm not going to wait to get back up above it either. I mean, that you can see it's kind of, if you like the Fed's late to the party strategy, then I guess that would be, great. But again, I don't think the 200-day moving average for me as a relatively short-term trader. I mean, I look long-term. I'm not going to say I ignore long-term action. I think all of members of Earnings Beats know we take a serious look at the long-term chart. We use that for perspective. But as far as trying to beat the S&P 500, we're trying to do it in the short term with swing trading as opposed to buy and hold. And so trying to, stay on top of the shorter to intermediate term moves within that big picture is critical to us. Anyway, volatility index, the history of the VIX, and there's never been an exception to this rule. When you are in what you believe is a bear market, particularly cyclical bear market within a secular bull, the VIX during bear markets has never, I don't use never and always very often, but the VIX has never gone below 16 in the middle of a bear market. In other words, where you're going down, you bounce back up, the VIX goes below 16, then you go back down to another new low. Never happened. Now, some would argue, well, back in 2007, 2000 to 2003, the VIX shot up and then it went back down below 16. And then in 2007 to 2009, the secular bear market continued. In between those two bear markets in 2000 to 2002, and then again, 2007 to 2009, we had a cyclical bull. So we were actually coming down from roughly the all-time highs when we started a bear market in 2007. So to me, that doesn't count. What I'm talking about is within the same bear market where you're going down 20% or more. When you come back down, or when you come back up in the market and the VIX goes down below 16, that bear market has ended every single time. We've never gone back down to a new low before going back up and hitting highs again. So just throwing it out there. I mean, every record is meant to be broken, right? Maybe someday that'll happen. Maybe we go down to 1575 on the VIX. We don't quite get to 6100. The bottom drops out, and then we go back down and set a new low. That would be the first time in history, at least since we've had access to the VIX. And it makes sense to me. It's common sense. The volatility index is giving us the level of fear, the level of expected volatility, which volatility is associated with fear. And so if that number's coming down, it's telling us that the fear is coming out of the market. And if there's one common ingredient among every single bear market, is that fear completely takes over. We lose our minds emotionally to the downside. We watch our portfolios drop, and then they really start to accelerate and we panic. Think we're going to lose everything we own, so we jump out of the market. And usually right around that time or pretty close to that, that's when the market reverses and goes back to the upside. That's been the history. So what we do is, I kind of take a little bit of a Warren Buffett approach. When the market's toppy and we're seeing a lot of signals that are saying, hey, you want to be careful here, move to cash. And then when you get the selling and you get the capitulation and you get a VIX that's at 55, it's time to think about putting money back in the market. If that didn't work out this time for you, remember this for next time. Learn from this. Trust me, I had to learn. I couldn't, I couldn't tell you anything about the market and where it was going to go 30 years ago. It's from many, many years of study and research that I've come up with ways to at least give me some signals that, hey, I need to be careful. Maybe I don't want to take as much risk right now because of X, X, and X. And then when you get to the bottom, you know how bottoms form. We've talked about how bottoms form. I've had shows where I've talked about how bear market bottoms form and what to look for. And this one was perfect. It's set up just like almost every other one. Anyhow, so anyway, solid day yesterday. I expect with inflation news under control, I don't know that we're going to absolutely fly to the upside. We could continue this rally, but it's giving me more and more comfort that I want to be in this market. And that if we do pull back, or when we do pull back, because we will, I'm going to be looking for rising 20-day moving averages to hold as support. That's going to be the primary. There's some price support levels we can watch as well. Moving on, sectors. So yesterday, take a look at what was leading. We had this huge day to the upside: consumer discretionary and technology. Look at what's down here on the bottom, or toward the bottom: consumer staples. The consumer stocks have completely flipped on their head the last 5 weeks. Money is rotating heavily into discretionary and out of staples, especially during the trading day, if we ignore gaps. And Earnings Beats members, you know exactly what I'm talking about, because every Monday in that weekly market report, I will provide a chart of the XLY, XLP, and there's 2 panels. One of them shows you the intraday movement, and you have to do a user-defined index for this, by the way. Stock Charts doesn't have the data. I calculate the data manually in an Excel spreadsheet, and then I use a user-defined index to get my numbers and formulas and everything posted onto a user-defined index so I can chart it. And you know exactly what's been happening with the XLY versus the XLP now for the last, probably since mid-March. The ratio has been going straight up. And prior to that, back in late last year, before market even topped, we saw that going down. What's that mean? It means money is rotating. It means Wall Street at the top was moving and getting much more defensive. They weren't telling us anything. If you didn't see it on the chart, you didn't know what was happening. Then you get to the bottom, and what we've seen is, since the market, even when we went lower and we had that capitulatory move early April, I mean, the S&P 500 dropped, I don't know, more than 10% over 3 days, probably close to 12, 15%. If we look at the intraday low at 48.35 from where it was 3 days prior, April 2nd, I think was the close. Anyhow, big drop to the downside, but most of it was gaps. Very little selling during the day. And since March 13th, since that March 13th low, let me just come over here and show you this chart right here. Since this low right here, March 13th, all the way to here, the gaps, well, I did this on the QQQ, so it's probably a little bit, let me pull up the QQQ. So from here, it was like 467, and now we're at 508 roughly. So I don't know exactly how many points, but it was like, and it might have even been, yeah, I think it was actually before yesterday. The gaps, so this would have been going until the close on Friday of last week, which was at 488 right here with this little red candle. Let me kind of zero in here. So I'm talking about from March 13th low right here to the low from Friday of last week. You can see that the QQQ went up $20, but, the QQQ, but that's only part of the story. If you total all the gaps that took place between these 2 closes, which March 13th and April 9th, or excuse me, May 9th. So March 13th and May 9th. If you take all of the opening gaps between those 2 dates, the QQQ fell $42 at the opening bell net. So there were some gap ups, there were some gap downs. You can see some massive gap downs here as we hit the rock bottom. But that was, in my opinion, the height of the manipulation by market makers. Bad news was out there. Everyone was panicking. I think that's when President Trump laid out his plan for the tariffs, and everyone was just saying, oh, that's horrible. We're going down. And a lot of it was politically motivated. A lot of folks, I don't like getting into the politics. I've said I stick to the charts, and that's exactly what I did here. This move down was orchestrated. It was orchestrated by Wall Street. You can say it, look at it, believe whatever you want. You're never going to convince me it wasn't orchestrated by Wall Street. Like at every bottom where you have capitulation, they take advantage of the fear. We get big gap downs. Everyone gets panicked, thinks, oh my gosh, the sky's falling. They sell, and market makers and their Wall Street colleagues and friends are right there saying, give me all your shares. And they start buying, which is why the gaps from March 13th to May 9th were minus $42. But during the day, the QQQ went up $62. There was a $20 change, 42 at the open, 62 after that. So anybody selling into all that weakness, that was market makers just taking all your shares for their wealthy clients. I call it legalized thievery, but it happens. And it happened with the VIX over 20, which is another rule that I follow. When the VIX is over 20, not many good things happen when the VIX is over 20, especially when it's over 20 and going up. Until you see capitulation, which usually is in the form of a very high VIX, multiple gap downs, panic in the streets, that's when you're going to get those rebounds back to the upside. And like I said, if this one has hit you hard, learn from it, because there's still a lot of money to be made from this point forward in the stock market. Learn from it. Take advantage of it. That's what we were trying to do and what we did do. IWM, I mentioned there was a big level to watch. If we pull up, and by the way, I'm switching over to this new Sharp Charts version. I'm finally being convinced by my friends at Stock Charts that it's time. I need to switch over. So I am trying to get used to it. Things are in different places, like the crosshairs right here. Usually I was clicking over here for the Mr. Inspector button, and now I found it over here. So this kind of gives you the crosshairs. We can kind of see what intraday prices and all what was going on. Anyway, if you look back over at March 24th on this rally attempt, we got up to 208.86. So I did remember that to the penny. 208.86. From there, we went down, set the low, came back up yesterday. We opened with that huge gap up. We opened at 208.84, 2 pennies below resistance. Went up to 209.73 intraday, and then came back down and closed at 207.86 or 207.87, which was about $1 below that 208.86 level. So this is going to be kind of a key area on the small caps, because it looks to me like a bottoming head and shoulder pattern. Now, it doesn't have to print a right shoulder. We don't have to have a head and shoulder pattern, a reversing head and shoulder pattern to bottom. It's just one pattern that can evolve. And so recognizing it early, I think, is important. But if we were to pull back into the right shoulder, that would be almost perfectly symmetrical to the left shoulder if we were to pull back to the 20-day moving average. So I'm just throwing it out there. I was actually thinking, well, if we got a higher than expected CPI report, I could easily see that happening, going back down and testing the 20. But now with a better than expected CPI report, it's going to be really interesting. I'm going to give you the latest here now, because we got 7 minutes to the open, and the IWM is at 209.28. So we're pulling further and further, just slightly away from where we were. So 209.28 versus that 208.86. So we're now 42 cents above, and we'll see in 7 minutes whether we can hold that. But to me, it's a big deal. I like to see key candle body resistance broken on the open, either to the upside, that's bullish, or to the downside, which alternatively is bearish. Transports. I said earlier, transports, what a great day they had yesterday. Check this out, up 7%. Without a doubt, since the high back in November, in my opinion, there's no day even close. I mean, you could say, obviously the big day when the NASDAQ went up 11 or 12%. And I think that's when there was some positive tariff news that came out that day. Had that huge move up middle of the day, if you recall. I would say yesterday's was even more bullish than that day, because that day we were very, very oversold. We were way below the 20-day moving average. We honestly needed a bounce at that point, and we got it. And then we got it really quickly, and we got a big bounce, but we were still contained below the 20-day. So technically, yeah, it was nice to have that day, but we hadn't done anything yet on the chart technically to make it look like we had reversed this downtrend. Since that happened, you can see we made a break above that candle and above the 20-day, went back, tested the 20-day, and now have broken out above those recent highs. So another higher high, and we're now distancing ourselves from that 20-day moving average, which is turning up. And if you go back and you look, we saw it turn up one time, late January, second half of January. I don't see any crazy moves to the upside. clearing that 20-day, and then falling back apart, and also went back up and hit the 17,000 level, which was a prior support area that broke down. So we went up, we tested that from underneath, put in essentially a double top, and it's been down ever since. This looks pretty encouraging. And to be quite honest, I think transports and small caps, mid caps, I think all of that's going to be really important to a big run coming up or continuing into the latter part of this year. So I wouldn't be surprised to see continuing leadership here. We're going to have some key areas of resistance to talk about. One we're at right now, right around 15,000. You can see that's where we hesitated multiple days at the end of March, early April, right before we tumbled. So now we've gotten all that back. We're back up to that gap resistance level, and can we get through? So one group to watch today, I would say, would definitely be the transports. Volatility index, I talked about this earlier. I don't want to spend a whole lot of time here, but you can see the big gap down right there. That was yesterday's gap down, but the whole downtrend has been continuing. And if we go back down below this March low, around 17, especially, like I said, history tells us we don't go below 16 in a bear market. So if you believe this bear market, we're going to roll over and go back to new lows, you do not want to see the VIX go below 16. If you do, you're going to be needing the market and this bear market to do something it's never done before, which is to rekindle while the VIX, which marks fear, I mean, that's kind of our fear meter, when the VIX goes below 17 or 16. So another big drop like this, one more drop of 16%, we'd be there. Let's see what else we have. 10-year Treasury yield. So, all right, I said 4.3. We've kind of come up the last few days. We're sitting at 4.45, but my point remains. You don't buy a 10-year Treasury yield, you don't buy a 10-year Treasury with a yield of 4.45% if you believe inflation's about to surge because of tariffs. And now that we've got positive talks going with tariffs, with the UK and with China, I mean, a lot of what caused the fear has been removed. The market doesn't like uncertainty, but a lot of that uncertainty has either been removed or at least delayed for a period of time. We're not, we've got time to maybe still keep the economy strong enough where maybe we avert a recession. Maybe we're already in one. We already had one GDP reading that went below zero. We'll see. But like I said in my video over the weekend, I just went through earnings reports. Earnings reports were awesome. I've got 550 companies on our strong earnings chart list, which is one of the highest levels I've ever seen. So earnings came in really good. I've got raised guidance now of, 350, 370 stocks, companies on the raised guidance chart list. So everybody who was thinking that, guidance was going to be poor because of the tariffs, that was not the case. Not based on what I researched and saw. So I'm telling you, I think a lot of what went on in the media for the last 60 to 90 days, it wasn't factual. And time and the charts are proving that out. All right, got a big event coming up this Saturday, especially with everything going on. Mark your calendar. This Saturday, 10 a.m., this is going to be a free event. Free. Zero. No reason not to come. I'm going to talk a little bit about what we saw, why I felt like we were bottoming when we did. I'm going to talk about how you build a winning portfolio. One of the things that you have to recognize, if you're going to build a winning portfolio, you need to have some sense of whether the market's going to go up or down. You got to have some conviction. Are you going to be right all the time? No. But if you do your homework and you follow signals that have been tested in the past and have worked, you can come up with a much better plan of putting together a portfolio than listening to all the clowns on CNBC. And to me, that's what it is. Just a bunch of entertainment. Might as well be Barnum and Bailey circus. They're not giving you anything worthwhile to call the market to make money. Instead, you're going to be taken right down the rabbit hole. They're going to lead you down the rabbit hole. We're going to lead you out of the rabbit hole. Come join us on Saturday. If you click on that link, it'll bring up this page right here. All you got to do, name and email address, and you're registered. Come on in and see us on Saturday at 10 a.m. But you can go through all of this. Got a lot of information in here. I mean, this is how we build our model portfolio. So when I talk about building a winning portfolio, I'm not just talking about some words. This is what we've done, and it's been tracked every quarter with recordings at our website. We have gone from back in 2018, that was November 19th, 2018. If you put 100,000 in our model portfolio, and listen, we are not registered investment advisors. We do this for educational purposes, but you can invest however you want. Our model portfolio has gone from 100,000 in 2018, latter part of 2018, which, by the way, was right in the middle of a trade war. It was right in the middle of a cyclical bear market. That's when we started this. Talk about bad timing. And then just a little over a year later, we had a pandemic. And then 2 years later, we had inflation, another bear market. And then we had a correction in 2023, 10%, and then another bear market in 2025. And we've gone from 100,000 through all that to 361,000. Look at our competition. I think, we've crushed the NASDAQ. We've crushed ARK funds. We've crushed the S&P 500, another ARK fund. Here's the Nifty 50, IBDs, aggressive plan. You'd probably still be sitting at about 100,000 right now if you listen to that for the last 6 years. We have a proven method. Come in Saturday and we'll get you started. We'll get you on the right foot. Now we're going to pull up a screen, because if you're on your mobile device, you can simply scan the QR code that's on your screen, and you'll be able to register. But the other thing is, even if you can't make it on Saturday, it's important to register, because if you register, we'll have a copy, and we'll make sure you get a copy of the recording. So you can go back and review it at your leisure. So even if you can't come, make sure you get registered so you get a copy of that. All right, just a couple other things before we wrap up. It is 9:32 right now, so we'll take a look at what's going on in the market in just a second. I just wanted to pull up a couple of the Mag 7 stocks quickly. We've got Apple, which has just opened. It is up 57 cents today, sitting at $211.24, trying to get above about $214. This is a move that would take us not only through 213, 214 price resistance, but also get us on the upper side of the 50-day moving average, which certainly would help technically. Microsoft, this is one I talked about before the earnings came out. Really liked what was going on in terms of manipulation on Microsoft. Lots of gap downs, lots of intraday buying. That told me Wall Street was accumulating this stock. Now, after earnings, we can look back and see why. Huge report out of Microsoft. Huge gap up, now back getting close to 52-week and all-time highs. This is how the market works, unfortunately. But take notes, because you don't want it to happen to you again. And it will. Market will have another bear market, cyclical probably in the next couple years. Anyway, NVIDIA. Just talked about this over the weekend. NVIDIA loves, and I'm going to stop with this one, but it loves the month when it reports earnings. Let me show you the seasonality on NVIDIA. By the way, NVIDIA reports, I think, on May 25th or 26th, something like that. Or maybe I just gave you the weekend. I don't know, whatever day is right around there. But they do report in about 2 weeks. And NVIDIA, here's the last 5 years, but I'm going to take you back all 20 years, as far as I can go back here, 20 years. Look at the months that go up the most often. February, May, August, November. Those are the 4 earnings months of NVIDIA. That's when they report their earnings. So what this chart tells me is that they historically have nice run-ups heading into earnings. Let's go back and look at that chart again. What's going on here? Well, it looks to me like we're having a pretty good run-up here in May. Earnings coming out in a couple weeks. It's doing what it always does. Likes to run up into its earnings report. All right. Let's go ahead and let's just go back to the main page, see where we are right now, wrap this thing up. So the Dow's down about 0.5%. United Health Group is part of that. S&P 500 is flat. NASDAQ, we got a little bit of momentum continuing to the upside, up 0.5%. Small caps up about 0.5% as well. So you can see pretty good move right out of the gate in the small caps. We're getting overbought. And by the way, if you want to join, another way to come to our webinar on Saturday without registering with your name and email is simply signing up for a 30-day trial to our service. Because if you do that, number one, it's free for 30 days. You do have to give your credit card though. But we will get back to you before you get charged. We always do that. We want to make sure you want to continue your membership. But we have an event tonight, Max Pain. We do this every month. We do it 3 days before monthly options expire. And monthly options always expire on the third Friday of the month, unless it's a holiday. It's always the third Friday of the month. So we always have this event on Tuesday before the third Friday. It's not always the third Tuesday. It could be the second Tuesday. But we always have it on the Tuesday before the third Friday. So we're going to be taking a look at a lot of stocks that have made huge moves over the course of the last 4 or 5 weeks and see whether or not there's a lot of in the money call premium on those stocks. If there is, then, and you're thinking about getting into the market, it might make sense to wait a little bit and see if they pull back with options expiring this Friday. Usually we see weakness if the market's been strong heading into option expiration week. We tend to see weakness, not a guarantee, but we tend to see weakness heading into option expiration Friday and even into the beginning of the next week, because not all options are closed out on Friday. Many are exercised. And if they're exercised, market makers are still on the other side of the trade going into the following week, which is why there's still an impact. Anyhow, lots to go over this morning, but hopefully we covered it in enough detail to help you as we try to navigate this market. I think we're heading back to all-time highs. I've said that before. I said it in the midst of while we were going down. I even said for those who like to be in long-term and don't really want to bother getting in and out of the market, just hold steady. I didn't know at the time we'd be going down 20%, but I did think it would be a short-lived kind of correction. That's what I was looking for, and it morphed into a bear market. But anyway, the market has come roaring right back. And I believe by, sometime in 2025, maybe much sooner than a lot of people think, we're going to be at all-time highs again and moving up. I believe probably at sometime in 2026, we're going to get a 7 handle on the S&P 500. We're going to go over 7,000. So I know we've come back a lot, but we should have never gone down in the first place, not to the extent that we did. It was media driven. It was fear driven. And you can thank your market makers for that. Anyhow, that's it for me. Have a great day, everybody. And I'll be back next Tuesday for Trading Places Live. And again, come see us tonight at Max Pain. You won't regret it. If you don't see us there, definitely sign up and come see us on Saturday morning. And we'll help you get started on building a winning portfolio. Have a great day, everybody. Happy trading.